Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
About 2 minutes away from the end of the trading day, Katie Greifeld and Scarlet Fu counting you down to the closing bell, and here to help take us beyond the bell. It's a global simulcast. We're joined now by Massar and Tim Stenovec. We bring together all of our audiences as we do so. And Carol, it looks like we're actually going to finish in the green today on the S&P 500, but just barely.
I feel like it's boring on the equity side of things. I think where the interest is really kind of on what you guys always like to talk about.
The bond market.
Exactly, right? We saw yields back off after that weaker jobless.
I'm sorry, do you know who just walked by, Carol? Romaine. He just walked by and looked in here over your shoulder, Carol, as you were doing the simulcast.
I'm now looking over to see if he walked by.
You can't keep this guy away.
What's up with that? What's up with that?
I think it's okay.
He's going to make a guest appearance a little bit later on. He's speaking with a special guest.
Markets are so boring today, I have to come in and shake things up.
I thought he had the day off. This is what happens. He's so excited. I'm sorry, Carol. I interrupted you.
No, that's okay. Take it away. Where are we going?
I'm sorry. I wanted to talk about what we heard from Michael Sheldon over at RDM Financial Group, Hightower RDM Financial Group. He said that, I think it's kind of clear at this point. The tone of the market has just completely shifted since late October. And it sort of seems like each day we get more and more evidence, whether it's data, whether it's CEOs of companies telling us that, okay, we are indeed seeing cooling. We're seeing it back, kind of seeing what the Fed wants to see. And look at the way that equity investors have reacted to it.
He says market internals are improving, which is kind of interesting.
Improving, perhaps. We'll see. You take a look at market internals today, about 10 seconds away from those closing bells. The S&P 500, again, a very slight gain, up about 13% on some softer volume than normal. You take a look at the Nasdaq, same story there, up about 0.1%. You take a look at the Dow, again, small moves here. The Dow finishing about 0.1% lower, Carol. And it just feels like all the fireworks are at the start of the week.
Yeah, Russell, though, man, that was taking a little bit more of a beating. If you look on a percentage basis, compare with the kind of other indices, the larger cap indices, small cap Scarlet down about 1.5% in today's trade. So a little bit of a pullback.
Yeah, even if you do think that the U.S. economy is going to go through a softish landing, perhaps a mild recession, that idea the economy will hold up better than most, small caps are looking more and more like some kind of value trap because they're just not getting the bid that you thought they would. By the way, Carol, you mentioned since late October, or Tim, you did, the S&P 500 has seen 14 trading days. It's gained in all but 2 of those days, up 9.5% in that period. So pretty remarkable. That's
amazing. That's like a year. That would be a good year of gains in the S&P 500 happening in 12 trading days, Scarlett?
14 trading days.
Wow.
Yeah, so let me just walk you through what's going on here very quickly. You have the 24 industry groups, pretty mixed day given where we are with the S&P 500. Insurers, software, and media entertainment leading the way, each up by at least 0.9%. On the downside, you've got food and staples, that's Walmart, autos, and energy stocks. Energy stocks, of course, really getting hit because of the drop in oil prices.
All right, guys, let's get to some of the individual gainers. Intel, top in the S&P 500 and the Nasdaq 100. They got an upgrade by Mizuho to buy from neutral, saying the company was lining up significant new server products in the next 6 months. Upgrade specifically reflecting a PC and data center rebound in 2024, so next year, and a better compute and data center product roadmap. That's coming from the analysts over there. Price target set to 50 from 37 a share. Stock closing at about 43 and change today. That's the number one gainer in the S&P 500 and the Nasdaq 100. The number 2 gainer was Intuitive Surgical, which has been under pressure. All of these companies that have been under pressure as a result of the rise in this new class of weight loss drugs. So you're talking about glucose monitoring companies like Dexcom. Intuitive Surgical has also been under pressure. It dropped about 27% from mid-July to the end of October. Well, investors are buying it once again. It's up about 16% since the end of October, but rallying in today's session, as you can see, up about 3.5%. No real news, but it's just interesting that investors continue to move into it. Retail, we've been talking about it. You guys have too. Got to do it. Macy's, definitely one of the outperformers in today's session, up almost 15% at its highs today, finishing the day just shy of a 6% gain, better than forecasted profit, and that's despite comp sales down for a consecutive third straight quarter. We talked about this earlier, right? Better inventory management. That really helped out during the quarter.
All right, well, let's go to some of the decliners on the day today. You talked about Macy's rise, Carol. I'll talk about Walmart's decline. Shares falling 8% today, the most in more than a year. This after the company expressed concern about the outlook for U.S. shoppers after signs of weakness in the second half of October. The company's CFO said that there was, quote, sharper fall off in sales during the last 2 weeks of the fiscal third quarter. That ended at the end of October, of course. Higher interest rates, dwindling savings, student loan repayments, all of those things weighing on demand. November, though, off to a good start. This was the second worst performer on a percentage basis in the S&P 500. The worst performer on a percentage basis in the S&P 500 today goes to Cisco Systems. It's the largest maker of networking equipment. Today, it tumbled the most since May of last year. That's about a year and a half, falling 9.8%. Its revenue forecast raised concerns that companies are reining in their tech spending. Let's look at shares of Carvana. This is an interesting one today. How about Amazon priming your next car? What do you think of that, Katie?
What do I think of that? I think Romaine Bostick is actually offset, trying to distract me. I want to talk about yields.
Okay, well, I'm not going to you quite yet. Okay. Shares of Carvana falling today by 5.3%. Legacy auto dealers slumping today after Amazon announced an online car sales partnership with Hyundai Motors.
All right.
So you could order that car on Amazon at some point soon.
She has a Honda.
Do I talk about yields now?
You can.
Yes, please.
Or your Honda.
Or my Honda. Let's go with yields because, again, like Carol said, all the action was in the bond market today, and it was actually in a good way. You saw a big rally coming into the bond market, pretty even across the curve. 2-year yields down about 7 basis points, 10-year yields down about 8 basis points. Take a look at the level on the 10-year, 444. Remember when we were above 5%? I barely can. This is the lowest level in really about 2 months since the end of August or so, and it really just speaks to the whiplash that we've seen in the bond market. But it feels like people are really buying into that soft landing narrative. Maybe the Fed can have its cake, eat it too. And you're seeing a lot of, I don't know if you could call it panic or agita get priced out of the bond market right now.
For now. Because it could all change tomorrow.
That's very true.
All right, let's take a look at what's going on with earnings because Ross Stores, another off-price retailer, has just reported earnings. It is rising in the after-hours trade after third quarter EPS topped analyst estimates by 11 cents, $1.33 for the fiscal third quarter. Comparable sales rose 5%, better than the expected 3.1%. As for the forecast, Ross Stores sees fourth quarter comparable sales rising 1 to 2%. The previous estimate was for 2.3%. And it also sees full year EPS of $5.30 to $5.36. That is an increase from its previous range, and analysts are below either ranges of $5.27. So the stock moving up by 3.6%, kind of a contrast to TJX, the owner of TJ Maxx, which also had a beat and raise quarter, but perhaps a lot of people were expecting more from TJX.
Well, and I'm looking at the press release. The CEO, Barbara Rentler, commenting. She says, we're pleased both sales and earnings outperformed our expectations for the quarter as customers responded favorably to the terrific values we offered throughout the store. Operating margin, she says, as Scarlett, you just mentioned, was up 11.2%, up from 9.8% last year. She said as leverage from the same-store sales gain and lower freight costs were partially offset by higher incentives and store wages.
Okay,
so there's some different things going on, some
but
dynamics.
But think about what she's saying there. I mean, even though fuel costs were lower, they still had to put stuff on sale more, Katie, in order to attract people into the stores to buy those things. And then, of course, you have the wage story coming into this. So, and she's still feeling pressure on the wage front, and that's going to hit margins.
Yeah, there's honestly a lot of cross currents to parse through reading through this release. Again, you take a look at the after hours action and it seems uniformly positive. I don't know about you guys. We've been watching retailers report all week. It feels like there's not one narrative that we can settle on. It feels very idiosyncratic.
Except for inventory management.
True.
That's it.
Yeah, but even then, like if you want people to buy in your stores, you need to provide a good experience, and that does mean staffing up because you can have all the inventory there, but if you don't have the staff to push those sales through, people will just get fed up and walk out, as we're talking about in the last hour.
No, it seems like it's all over the map, so it's going to be very interesting. We just talked with two members of the Bloomberg Intelligence team who said, you know, it's a reminder. It's called Black Friday because it's when retail turns profitable for the year. That fourth quarter is so important, even for a retailer like Walmart. So this last quarter is going to be really important for these guys.
Yeah, and the fact is people right now, in order to save up to actually buy stuff this holiday season, they're pulling back on other spending, potentially spending in the services category. So think restaurants are not not eating out as much or spending as much money at these restaurants so they can actually buy things this holiday season.
Yeah, although if you trust Walmart and you believe what Doug McMillan is saying, maybe those things will cost a little bit less in 2024.
Yeah,
Talk about
Absolutely.
too bad that's after the holiday quarter, right?
So where's the narrative, right? Like that's the point, right? It's like kind of, it feels like all over the place.